Ladies and gentlemen, welcome back to Real Estate Investing with Alex Deacon. We hope you had a fantastic Easter weekend here in the United States. Alex, how are you doing today, good sir?
I am doing fantastic. How are you, buddy?
You know what? Not doing too bad on this rainy Friday in Pittsburgh, Pennsylvania. But, Alex, we've been covering a lot of topics lately. We kind of had a meeting of the minds, and since you're the brilliant one here, today it looks like we're talking about how to choose a neighborhood to invest in and what to look for.
Yep, thought it would be something good to talk about. I was reading through a blog, and this kind of popped up as something we haven't really gone into and discussed in detail. So I think we're going to do that today. And we'll probably go off on a bunch of different tangents, but we'll start with I don't know, maybe some questions you might have, and then we'll dive into it.
All right, so I guess being the naive rookie who isn't yet in real estate, the big stigma when it comes to neighborhoods is don't go to neighborhood A, B, or C because you might have to deal with person A, B, or C. You know, is that are the stereotypes and the stigmas that are attached to all neighborhoods correct, or are those just all fallacies that you need to look past?
Yeah, I do look past all of that because you don't really know till you get really to know the area street by street. Because one good example is we just talked about like where you live, and you live in he lives in a part of town called Elliott, which is part of Pittsburgh, and Elliott's got a rough area, and it's got a really rough area, then it's got a decent area, then it's got a nice area. Mm-hmm. So within that area, there's probably 4 different areas within the area, you know. So I wouldn't mind living where you are because it's away from most of the riffraff,
the chaos.
And it's quiet, and that's the way really every neighborhood is. There might even be ways to even break it down even further, but that's how I do it. I break all neighborhoods down into. So when we talk about like an A-class neighborhood, that's typically in my world, that means, okay, you either have a really good school district, which is normally the case, and it's highly desirable. So therefore you have most families who are making well over the average income of the area are going to be moving there because they want their kids to go to the best school. That's an area that everybody wants to invest in because it's the safest, it makes the most sense. But what do you think the downside would be from an investor's point of view if you want to buy in a really
cost? Yeah,
cost. You're not going to get. You're very rarely going to get any sort of cash flow. In fact, you might get negative cash flow, but you will get a return. You know, long run, you will get a return. So areas are good, and but you need. So I guess the topic today is what neighborhoods to buy in, but you need to ask yourself the question is, what do I want my portfolio to look like? Am I doing this to be safe? So safe would be, in my opinion, would be A or B or maybe C+. That's safe, right? Okay. Do you want to go a little bit riskier with the potential of a higher return on investment? Then you go with, instead of A and B areas, so we'll say low risk would be B and C areas, and then you get the higher risk, which is basically D areas. Mm-hmm. So D area to contrast from what an A area is a D area is high crime, low average income throughout that area, and just visually when you drive through it, you can just see it's a D area. It's just not clean. The houses are boarded up. You might see in the news that there's a lot of things going on that you wouldn't want to be around and you wouldn't want to live there. But so the downside of buying in a D area is you have to live with that. You're living with your tenants that are basically, they don't have a whole lot to lose. And I'm not ditching on folks that don't have a lot of money. I mean, it's a fact of life. If you don't have a lot of money, it doesn't mean you're any less than a person who's a billionaire at all. But what we see though on a regular basis is if you don't do your screening correctly, and even if you do, you're still going to get burned.
Right.
You know, like I might have 1 out of 100 properties that are in A areas that we have a problem tenant, right? The one that's a real problem that we have to evict and they're just causing trouble or dealing drugs or they're not paying the rent and we have to evict them or whatever. It's like 1 out of 100. If you're buying in a D area, it might be 1 out of 10 or 1 out of 5. So that's the trade-off. And that's when you run your numbers on a D area, you have to run them differently. The vacancy has to be maybe higher. The legal column where you're going to spend more for legal and evictions has to be higher.
Right.
Your
potential losses,
management fee is going to be higher because we're going to charge at my management company. We'll charge less for a higher rent in a good area because it's less work.
Right.
You know, we're going to work half as much and make twice as much to rent a portfolio in an A area than we are in a D area.
Right.
So you just have to adjust your numbers. The huge upside, it's not just adjust your numbers, you have to adjust the way you manage and the way you understand. Your expectations have to be set at that D level. You know, you can't have A expectations. You're not going to get 900, there isn't even a 900 credit score. You're not going to get 800, 700 credit scores in the area.
Yeah,
it just does not happen. You're not going to get in a $700 single family home, 3-bedroom rental, a person that's making 6 figures. That's not going to happen either. Very rarely.
No.
You just have to be adjustable. You have to be flexible.
One question I have is, and this there might not be one true answer to this, and I think that's why I feel it could be an important question. Is there any one lever, like say schools versus maybe problem? I don't want to say tenants because obviously you're talking about your surrounding neighbors, but maybe a higher crime rate, better school. What's the biggest lever do you see that could affect a property value? Is there one in particular, or does it vary from neighborhood to neighborhood? So that's why it's important to know.
Are you asking me like what makes a property an A or a B?
Yeah. Is it? Typically, do you see? Is it the school system that could increase that value? Is it a lower crime rate? Is it a mixture of everything? Could this neighborhood? Could it be that it's a good school, even though like crime is a little more? And then in the next neighborhood over, there's no crime whatsoever. But...
Yeah. Okay. No, it's a combination.
Okay.
Yeah, it's definitely a combination. Typically, I would think it's school district, right?
Okay.
But here's one that's different. It has to do when you're in the city of Pittsburgh. City of Pittsburgh schools doesn't have the best reputation. Okay,
that's why
so
my daughter does
when you're going to live in let's say a Lawrenceville, which Lawrenceville is like trendy, South Side it can be trendy. Bloomfield, trendy is what I see is there's shopping nearby. Like you can walk down to the Broadway and just go to different shops. You can get anything from tattoos to coffee to Chinese to resale shops. It's just a nice shopping section, and usually higher end. Like you always see a Starbucks or something like that, but they don't have a good school district.
Right.
But if you bought in Lawrenceville 10 years ago and you're selling now, you're making millions. So Lawrenceville is an A area right now, but it doesn't have a good school district.
Gotcha. There we go. Okay.
So it's not always school district, for sure. So usually suburbs. Oh, excuse me, suburbs. Usually suburbs are school district.
Okay.
Come to think of it, I never thought about it that
Probably
way.
more rural areas, like once you get out, like maybe Beaver County, Butler County.
Not even. There's like Carnegie, Upper St. Clair, Scott Township. They're all outside of the city parameters.
Good deal. Yeah.
But within the city, there are definitely hot spots that you need to look for.
Okay.
So that's a good question. So it's not always school district, but just to focus back on an A area, and then we'll work our way down. An A area, typically in a suburb, is a good school district, higher income, higher sale prices, and lower returns. So you have to visualize as an investor, what do I want my portfolio to look like? Do I want it to be all in A areas? Then fine. You're going to buy in A areas, and that's not a bad thing. You're just going to find probably less deals. You're going to get less return up front. I think on the back end, you're going to get just as good of a return, to be honest. But up front, you're not going to see that, and it's going to take longer to build the portfolio. Is that what you want to do? And a lot of the questions I'm asking you here really boil down to how much money do you have? Because I can't afford, me personally, to buy everything in an A area. I just don't have enough funds.
Resources, right?
Yeah.
Right.
So I try to buy in less desirable areas, but are still good.
And I would imagine, especially in the A areas, more of like a catch and hold type scenario is that's your long game in A areas, correct? As far as like really seeing the profit, down the line.
It's just safe.
Exactly,
it's very safe, low risk, low return.
Yep.
That's all. Yeah. But I do buy in A areas. I buy in the full spectrum. I don't focus on one specific spectrum.
Do you think that's important to have?
It's not. It isn't. I always
There's
think
the honesty.
It is. It isn't. You could be focused on one specific area. I know investors that are focused on one specific area, and they are just hell bent on it, and they are in deep. They're in 100%. And there's nothing wrong with that, because it could be something wrong with that, right? If that area doesn't work out, right? If you're not prudent on your due diligence and you don't do your homework, then being focused can be bad. Mm-hmm. But if you're really focused and you really know the area and you know every little intricacy about it, and what's going on and what's coming down the pike, you can be hugely successful. I just choose to be more diversified.
And that's the beauty, I think, of real estate investing. It's all personal preference.
Mm-hmm. Yeah, so when I get the question asked me all the time, where do you buy? I said, I buy everywhere. And, well, where should I buy? I don't know. I don't know your tolerance for... you have to have a different tolerance level for A to D.
Yes.
A is, your tolerance level can be much lower because there's less stress and less problems. So to ask me, where should I buy? One way to delineate that is, how much money do you have to invest? If you don't have a lot, then you might as well just rule out the A area, right? And if you have a low tolerance for just stress and your real estate IQ is not high enough to handle a D, then stay away from a D right now. So you can narrow down the areas based on how much you have to invest, and then your tolerance for your real estate IQ and your tolerance for stress and such. But these are things that every investor really needs to ask themselves. Instead of the question, which I'll get, hey, I got $100,000. What should I do with it? It should be. That's not a question. That's just somebody who's essentially just lazy and doesn't want to learn and put in the time. I mean, if you got $100,000 and you want to do something with it, lend it to me, and then I'll do something with it, and I'll give you 8, 9, 10, 12, 13% on your money. That's the answer. What do I do with it? Just give it to me, because I know what I'm doing.
Right.
So that's not the right question. The question has to be, the question should be, what should I do with it once I come up with a dream, a game plan, a goal, and once I have the education in order in my mind so I can implement that game plan. That's the lazy answer, is what do I do with $100,000? Okay, so we covered an A area. In an A area, you're gonna have 4 different areas, right? You're gonna have like super wealthy, forget about it. You're never gonna buy something in an A area. Right. We have an area like that in where I'm from, which is Collier Township, which would be Nevillewood, which there are literally probably a dozen or $20 million homes up there.
Golf course.
The rest of them are 500 to $1 million. So in Pittsburgh, that's a lot of money.
That's a lot of money.
Some areas in the country, that's like not a lot.
Just to put that in perspective, guys, because I'm also born and raised here in the Pittsburgh area. When you say $500,000 to $1 million, my stomach still sinks. And to know that's on the bottom end of it, it's my stomach going, ooh.
So that's like the upper echelon, which you're not going to buy real estate in typically. A B part of an A area, so that would be an AA area, right? This would be a B section of an A area would be, and you'll know these by driving through the neighborhoods. That's typically how you do it. There's a lot of research you could do online now, which is fantastic. You could be literally in another state or another country and drive the neighborhoods through Google Maps. It's incredible. But there's nothing better than getting here and seeing it. You get so much off the internet.
Especially now that it's springtime. You can get out again.
You have to be there. You have to see it. You have to feel it. And you have to get the vibe that's out there. And there's nothing that can take place of that. Nothing that can take place of just being here every day and doing it. And that's what I do. A B area is just essentially, one step down from an A. You're not getting the super school district. You're getting a good school district. You're getting average to over average income per household. More of a working class neighborhood would be B and C. What's really important is to know in the B and C areas is to know where is the good, what are those good neighborhoods, So you know a couple different things. What are the good areas of the B, C, and D? Right? We can really lump those three in together. If you're going to buy in those areas, in a B area, you could probably buy in the lower class of a B area. In a C and D area, you want to find the perimeter where it's still good. Okay? And again, we're being kind of a blanket statement about this, but you don't know until you get to those areas and start driving through them, and get to know agents who know the area and know other investors as they know what's going on. Like that's a flood zone down there, or that's high crime down there, or traffic's real bad down there during the day. Things like that you don't think about that will affect the rentability and the value of the property.
Yeah, and I mean, and I know, guys, anybody listening at home or during your commute, Alex spoke about where I live in, and we literally can't give a better example of my half of the street is wonderful, peaceful, tranquility. I mean, it's amazing. The other half of the street is like a constant frat party. So, and it's gotten better, but that's unless we would have gotten down there, because you hear all the stories. But it wasn't until we actually went down there, like, wait a minute, this isn't a bad area, and we found out it's actually one of the best neighborhoods I've lived in. It's amazing. So that's why you get out and look, ladies and gentlemen.
Yeah, because when you're out and looking, guess what your tenants are doing? They're doing the same thing. So you're not going to attract good tenants once they get to know the area.
Right.
You're going to attract what you attract. So the one that we can focus on now, because we talked, let's recap, because I'm kind of bouncing here. We talked about A areas, safe, low risk, no brainer, right? If the numbers can make sense and we can break even or even lose a little bit of money or make a 1 or 2% rate of return, you're doing well.
Wow, so even 1 or 2% on an A would be...
Yeah.
Okay.
Yeah. That's your cash on cash return. That's not like what your end return is going to be when you sell it. Because a $300,000 house that appreciates 3% every year in 10 years is worth a heck of a lot more, and that's your wealth there.
Right.
So every year your wealth is going up a lot, right? You're just not seeing it in your checkbook right now, but you're on a balance sheet. You're seeing it,
right.
And that's when you get your return.
Okay.
The D areas. Like B and C's are great. B and C areas are fantastic. You just got to know, like, what street by street, a little neighborhood within the neighborhoods, the little nuances of what's going on in that specific area. And we could just go through just tons and tons of things to look for, but that would take a long time to talk about. Now, a D area, you were going to ask.
I was thinking, just real briefly, in B and C areas, would those be the areas that you would recommend when you go look at properties? Sometimes it does, and I know you always kind of recommend kind of talking to the neighbors if you see them out. But the B and C areas, would those really be the areas where, let's talk to the neighbors and really find out what's, if this is the I guess the higher end C, the high, those, or all B, I guess would probably be good, but.
Yeah, anytime you could talk to anyone is good. You have to take it all with a grain of salt, because some people you might talk to a neighbor and they're just totally pessimistic and they give you a bad vibe. I've had that many times, and I know the area, so I'm like, I know you're just that kind of person, and you got to take it all with a grain of salt. You talk with the mailman, you talk with
find the neighborhood watchdog. You know, every neighborhood has that one person that they think they're
you want to gather information. You're not taking one person's point of view.
Yes.
You're just gathering information, and then the more you gather, sometimes the more confusing it can be too. But you just continue gathering information and continue knowing the neighborhoods by researching, by driving through them, by looking at houses. You get to absorb that. Okay. Now on a D area, that's where you can make really a lot of money, but the downside there is a lot of it is speculating. So when you're speculating, that means you're gambling. So a D area is like a good example would be East Liberty. 10 years ago, East Liberty was horrific. I mean, you could buy properties down there for just insanely low amounts of money. Mm-hmm. But what would you do with them? I mean, some of them were boarded up, some needed torn down. Every other home on a block was boarded up or had a fire or was torn down. And the ones that are rented, you're getting, some low class tenants there. Mm. And you're going to deal with that. So if you hedged your bets and said, I'm going to spend $1 million and I'm going to buy 2 blocks or 3 blocks in East Liberty 10 years ago, if what happened didn't happen down there, you'd be stuck. It would have been not a good investment at all.
That's one of those you roll the dice and...
Yeah, and how long can you wait? How long can you suffer through that? And how long financially can you do that? Because you're tying up all that cash and you're not seeing any sort of return. Now, the folks that saw the forest through the trees down there and they invested down there, they hit a grand slam because that place has exploded with just new construction and it's everything. It's just exploded down there.
Yeah, and just for anybody that might be listening that isn't in the Pittsburgh area, East Liberty is a little neighborhood in Pittsburgh. Mm-hmm. It was very run down, and through developing over there, it was like a good 5 or 6 year plan. It went from I don't know, it looked like nobody lived there. I mean, literally, it just was boarded up homes. I mean, to now it's incredible. I mean, it's absolutely incredible.
So when the reason I think, and that's easy to look back and say, oh, I know what happened there, but there's a lot of high tech stuff going on there. There was like Google. There was Google that came in. There's some hospitals down there. UPMC's big. There are some pretty high tech stuff going down there. Carnegie Mellon. A lot of that stuff's close, and that buzz started going around along with just some things starting to fall into place, and boom! Next thing you know, you have a booming market that you can't touch real estate down there now.
It's incredible.
But how do you see that 10 years ago? It's
I never would have thought of that 10 years ago.
It's just I don't know the magic pill for that one because I get that question asked all the time: is where's the next hotspot? I mean, I don't know, and if I knew, I probably wouldn't tell you.
And guys,
like if I had a crystal ball and it said this is the next hotspot, you think I'm going to tell everybody?
Right.
I don't know what the next hotspot is. Nobody knows.
And to give everybody an idea on how quick it could be, I actually moved out of the Pittsburgh area in 2007. Never would have imagined that East Liberty would ever have looked as nice as it did. Moved back in 2009, and by 2010, it was gorgeous already. So it could be that quick. But guys, again, that's a very that's the needle in a haystack kind of find. I mean, it's not results may vary, and this isn't your typical result.
So when buying in a D area, you want to make sure that your rate of return, you have to make sure that when you buy it, I mean, of course, unless you have endless amounts of money and you can wait, which most of us don't. So when you buy, you have to make sure that property is going to sustain itself based on what you paid for it. Like it's never going to go up in value. So when you buy it, know what you're getting into. Make sure it's going to be profitable somewhat, knowing that your speculative plan on the back end could gross you huge returns. Mm-hmm. But if it doesn't, you're still stuck with something that's okay, right?
Right.
And that's a good plan to have. When you go all in, and that ace doesn't show up on the river,
you're kind of stuck.
And you're out.
Yep.
That's it. So I don't like to play like that. Some people do, and those are again, we've talked about this. Those are the ones that you see on TV and in the movies. Those are the ones that go all in and won. They don't show you the 9,999 others that went all in and failed. Yeah. I don't like to fail, so you got to have some sort of contingency plan. Know when to risk, know how much to risk when you do real estate.
A wise man once said, "You always have to have a plan B."
Yeah. And a C and a D and an E.
Yep, exactly.
All right, so we discussed A, B, C, and D neighborhoods, and I don't know if that was helpful. It seemed like it should be, but I don't know. I'm not sure if I was helpful today.
I think you were helpful.
What do you think?
I think you were helpful, and especially because our market here in Pittsburgh is I'd like to say a little different than a lot of other markets. We're unique here, So, but I think this information would hold true in any market, in any climate, and no matter what it is, because you're all going to have different styles of neighborhoods. So I do think this information was very, very good, and I hope everybody at home got the same amount of information, at least took something away from it, like I did. So, thank you, good sir.
You're welcome.
Any other icing you want to put on top of this cake? Or are we wrapping this bad boy up?
Let's call it a wrap.
Calling it a wrap. Ladies and gentlemen, this was how to choose a neighborhood to invest in. As you can see, there's a ton of variables that you can look at. It's really about what you can handle. So go back in, start looking at your neighborhoods, talk to neighbors, look at homes, and start to figure out your plan from there. Listen, guys, make sure you're following all of our work on Facebook, on Twitter. Look up Deacon Hoover or DHRE on those websites. Find all of our podcasts on Google Play, Apple Music, I believe they're calling it now, or Apple Podcasts, Spreaker. Just type in Deacon Hoover into your favorite podcasting service, and you'll hear the Deacon of Real Estate, Alex Deacon, right here. You'll see his pop up along with Ian Hoover's The Realtor Nation podcast. So, for everyone here at Deacon Hoover Real Estate Advisors, I am Adam. This has been Alex, and for everyone else here, we thank you. We hope you enjoyed your Easter weekend. We're just about to start our Easter weekend. See you next week.